Welcome to our second segment, and this is the lesson of the week in emerging markets. This is for August 24, 2024. As we can see on Wednesday, we've had a nice, strong week on all over the globe, except the Chinese market, the Shenzhen especially. Not the Shanghai is still down, but Shenzhen has been the one who is really suffering. But other than that, what we see, France is slightly negative, although after Friday it became positive. Thailand is down 5.5%, and Mexico is down 6.1%. So, and then we look at the charts, we see that V recovery of the markets continues with all the majority of the global ETFs, as you can see. And you look at Germany, for instance, Germany and NASDAQ, they kind of follow each other. So as you can see, again, China is more of a flattish, but everything else is, look at this. This is all V-shape except Mexico. And that's about it. You see a lot of strength. Look at Spain, for instance. So let's do some lessons of the week. I'll start with the government debt. Obviously, we've been talking about this for about a year, I believe. You know, the governments cannot afford the higher interest rates. With all the debts that they have, it is unbearable, just the net interest expense and the interest service. It's just going to take care of all their GDP. So basically, it is important that to keep the rates lower if possible. So what we see here, this is the cost of borrowing, and the reason is, again, with all the borrowing on top of the higher rates, you see the net interest expense in the United States from 2021 to 2023 is 8.7%. but forecast is going up to 10.9%. And basically, that is this net interest expense, the percentage of the government revenue. So again, there's two, either you have to have a healthy economy and higher government revenues, or you have lower rates. So this is what's going on. Good news for UK is projection is actually lower, but Portugal will be higher, Spain, Italy, Greece, France, Germany, you know, as we look at the difference between Germany and the United States, Japan, and it's positive, Switzerland is good, Norway is on the negative. So it thinks that the government's earnings from investments such as foreign debt holdings exceeds its interest expense. The same thing, Denmark and Canada has a problem. I mean, Canada is positive. I mean, it's a negative now, but going forwards, they will have their own problems. So I think that is important about, again, the debt. So the interest in U.S. national debt is, again, is one of the fastest rising expenses in the federal budget. So that's what we have to be careful with, the interest rates. It is high, just the debt cost is now higher than the defense spending and Medicare. And with the, again, fiscal pressure, the U.S. deficit forecast to hit $1.9 trillion in 2024, which that means that the U.S. needs to issue even more treasury securities to fund its activities, which means more supply. So again, these are more reference. I hope you enjoy these information, or this as far as the information that we are sharing. Talking about debt, how about the global debt? As far as the total, it has reached $315 trillion. And basically, what we see, the trend, we started at $304 trillion, which was 347% of the GDP. Now, the good news is it kind of came down, but still that's 332.7% of the GDP. So again, the debt has surged by 21% since pandemic. which is $54.7 trillion of additional global debt. So these are very important, and I think that's what, again, we look at. Like any financial management, the debt is very important in servicing it. Talking about the other part, we talked about we want to have lower interest rates, but also revenues, and one of the biggest revenues comes from the taxes. So, what country has the highest tax revenues? Well, it's France at 46%, Italy is at 43%, Germany at 39%, and UK at 34%. Now, the Canadian government, they have 33%. So that means they are getting more revenue, so they can spend, they have a capability of higher spending. US is at 28%. So what we look at, we see countries like India and Indonesia, they are actually below the world average. So in this situation, what we have to look at is the World Bank is predicting that if you are over 15%, then the revenues are growing and it's helpful, and it could take care of your social services, and you are not in poverty. But whenever they found that if at least it's less than 15%, that could be the sign of trouble and could be sign of poverty. And in this situation, we see India and Indonesia. On the other hand, it does not apply to Saudi Arabia or United Arab Emirates and or Qatar. The reason is they have so much of earnings from the energy sector, from the oil and natural gas, that they do not tax their citizens that much because they don't need the revenues. So I hope that's clear. Again, US is at 28, Russia is at 23, Turkey is at 21, and China is at 20. How about the net wealth by region? And this is end of 2023 versus 2028 forecast. And basically, when you look at North America, we are going to go from 169 trillion to 227 trillion, which is the compounding annual growth rate is about 6%. Western Europe will have a 2% annual growth, and they go from 103 trillion to 121. We go to Asia Pacific, which is the second largest as far as regions, will move from 158 trillion to 209, and that's another 6%. The fastest growth will come from Middle East, Africa, and Latin America. Now, Latin America will go from 17 trillion to 26, and Middle East goes from 19 to 31. Eastern Europe and Central Asia will go from 11 trillion to 15 trillion dollars. So when we talk about, again, the financial wealth, it's the net wealth comes from financial wealth, real assets minus the liabilities. But the financial wealth is the cash and deposits, bonds, public and private equities, investment funds, life insurance and pensions, and cross-border wealth. So as you can see, North America accounts for over 50% of all the new financial wealth created, thanks to robust stock market gains, especially like S&P. But again, looking ahead, we talked about Asia Pacific would drive larger share of financial wealth. And as we talked about, North America going forwards in 2028, will account for 44% of $40 trillion, and Asia Pacific for 29% or $27 trillion. This is largely due to growth in India, which generated $588 billion in new financial wealth in 2023, which is the largest in its history. So talking about wealth, we talked about the gold just hit the all-time high, and we want to see what are the countries buying the most golds? And this is for the 10 years, past 10 years in tons, between 2013 and 2023. So Russia and China by far the number one and number two. You can see went from 1,035 to 2,333 tons, which is a huge growth. And we see actually Iraq and Thailand are number 9 and 10, and Turkey is number 3. Now, the United States remains the country with the highest overall gold reserves. It owns 8,133 tons, and half of the country's reserves are stored in the United States Bullion Depository, which is, if you ever watch James Bond movies, then it's like Fort Knox, Kentucky. And Germany ranks second with 3,351 tons, with Italy following by 2,452. Speaking of gold, what about commodity exports? There are $5.3 trillion of commodities. Now, as you can see, petroleum, oil, and its products actually accounts for 30% of the global commodity exports, valued at $1.5 trillion. And following that is the crop products and forestry. Then we get to the basic metals and other minerals, precious stones and metals, natural gas, coal, electricity, animal products at 446 billion, and the other agriculture is at $319 billion. Also, it was interesting to see there was some relationship with the country which usually has the highest skyscraper. Generally, economy goes downhill after that. So, whether it was Dubai or Malaysia, Kuala Lumpur. But it's very interesting that what countries have the most skyscrapers? And China, by far, has the most in the world. Now, we might think, when you think of a skyscraper, of course, we think about like Empire State Building or Chrysler, or, it used to be Sears Tower, and it was born here, but now China has 3,194, and 120 of them are more than 300 meters. So when you look at it, I mean, look how many United States or United Arab Emirates have compared to China. Now, a little tidbit that China takes the term skyscraper very seriously. It has roughly the same number of 300-meter or taller buildings, 120, as India has total skyscrapers. So India is number 12. And we can see number 4 is Malaysia, number 3 is United Arab Emirates, 2 is USA, and number 1 is China. So we talked about Fed chair, and we talked about the rates. What I want to pay attention to, look, this is telling us we are at 5.25 to 5.5 at this moment. We are 100% chance that there will be a rate cut. As a matter of fact, there's a 24% will have a 50 basis point rate cut. Now, after chair's speech at Jackson Hole on Friday, we actually had 36%. And then toward end of the day, it actually, the market had to digest it to 24%. I want to also see, this is for September, but when we look at actually the December meeting, the markets, what they are looking at is they actually thinking, remember, we're at 5.25. They are telling us the minimum by then will have 75 basis point. There's actually 44%. We could have 1 full percentage. So it could be maybe a 50 basis point in September and then a quarter, or maybe we'll have 3/4. Fed could be cautious, say, well, let's do a quarter in September, and then we do 1 in November and 1 in December. But regardless, right now, the markets are thinking of minimum of 75. all the way to 1.25. Actually, what you can see is 1.5% chance of there's a 2.4% there will be a 150 basis point cut. The other thing we want to look at, the implied federal funds rate based on the 30-day futures. So 30 days ago, the expectation, the forward rates was, it was the markets looking at, for instance, the expectation by February 25th was at 4.5%. By December 24th was, 4.75. Now, the current, after again the speech of Powell, he didn't sound hawkish at all. It was pretty helpful for the dovish markets. Look at the gap now. I mean, the markets are looking at 30-day forwards. The rates are much lower than we think about as far as expectation of the implied forward rates. I mentioned about Canadian Railroad decision and it came out, so it looks like the union thinks the companies won, and they're gonna, they want to have legal challenge against the decision. Also, Air Canada, the pilots concerned how ruling will affect their talks because they're in talks. Both railways, the Canadian Railways say they would have preferred a negotiated settlement, and they're focusing on restoring service. So, but again, something you want to pay attention to as far as a Canadian strike and how it affects again, the movement of goods and the especially with energy affecting consumers in the United States. One more thing, we found that with S&P 500 corporate cash at just 8.8% of assets, corporate buybacks are likely to peak soon. So just a food for thought, where we had been, and as far as the cash and where we are now, and we go back again to financial crisis time. So just thought that's a nice chart. Also, the breadth of the market looks like it's expanding. When we look back, this number of S&P stocks which are above their 20 moving average, a simple moving average, is over 89% of them. And that's the highest we've been since December of 2023. Above 50 is at 79% of them, and this is the highest since April 1st. And above 200 is at 76, and that's the highest since July 31st. So that's a good breadth, but also we don't want to overheat either. So when there's everything is above, that means we've gone too far out. So just a food for thought. Again, I'm looking for after day Labor Day weekend. Going to economy, the percent of US workers holding more than one job stands at 5.3%. This is the same as the end of the last economic expansion, but well below the 1990 peak of 6.5%. So it's, 2010 to 2019, the average was 4.9%, and we are actually above that. There's also a mixed message. As we look at the charts, we see that, wait a minute, the surging stocks with what the Fed has said, well, that the markets are looking at soft landing. But on the other hand, rising bonds and gold signal as insurance and safety that shows a hard landing. On the other hand, falling prices for economically sensitive oil and copper, and we've talked about that, point to weak global growth. And the lower USD raises doubts about international investor confidence. So I thought that was interesting. In the past, we've talked about internals and we've talked about the skew and how it's working and what is the skewness. Remember, we have the bell curve and everything is, we talk about the expected move, the 68% expectancy that everything falls in a normal curvature. But skewness is a distortion of symmetry that deviates from the symmetrical. Remember, the bell curve is symmetrical, a normal distribution. And what this means, and we will look at trade of the week, is looks like we are higher. What that means is the premium on options on the puts exceeds, generally, sometimes this goes the other way, the calls, when there was like a big attraction to the, let's say, Magnificent Seven, or when we had the Reddit Wall Street bet stocks in the past, the meme stocks. But generally, it shows that there's been more purchasing of or higher premium for the puts on the market than the calls. So that means there's a lot more hedging activities. So that's the skew. Last but not least, according to Statista, the number of Americans who cycled last year is surged by 3 million, reaching a total of 54.7 million in 2023. Strava's last year in Sports Trend report corroborates this boom, showing a 5% increase in cyclists recording metric century rides 62 miles and a 20% rise in e-bike ride recordings. Just a thought. For the first time since 2018, the US has more companies than China on Fortune's Global 500 list, which ranks the world's largest corporations by revenue. There were 139 US companies on Fortune's list. And that's just sharing with that. After almost 13 years of declines, balance on home equity lines of credit, which are known as HELOCs, have begun to rebound, gaining 20% since bottoming out at the end of 2021, according to the Federal Reserve Bank's New York's quarterly report. So I hope that was helpful. With that in mind, we will move on to our third segment, and that would be our trade of the week.